1920 saw the British Empire reach its maximum territorial extent. 35.5 million square kilometers, covering approximately 24% of Earth's land surface. Governing over 400 million people, representing about 25% of the world's population. By 1870, Britain controlled roughly 25% of global trade, despite having only 2% of the world's population, and occupying a relatively small island off the coast of Europe. And this wasn't military conquest alone, but financial engineering on a scale never seen before. The British Empire wasn't built primarily through superior armies or better weapons, though both played roles, but through superior access to capital, lower borrowing costs, more sophisticated financial instruments, and the ability to sustain longer wars and larger overseas operations than any rival power could match. Britain could borrow money at 3 to 8% interest when France paid 8 to 10% or higher. And that difference compounded over decades and centuries translated into the ability to field larger navies, maintain more distant garrisons, and fund allies against common enemies. 1694 laid the foundation with the creation of the Bank of England and the development of Britain's system of national debt. Before this financial revolution, Britain stood as a European backwater, weaker than France, poorer than the Dutch Republic, and unable to sustain the kind of military operations that empire building required. But after 1694, Britain developed the fiscal and financial capacity to defeat larger rivals, conquer vast territories, and maintain control over the largest empire in human history for over 2 centuries. This video covers how Britain's financial revolution transformed a small island into a global superpower, why the Bank of England and national debt system gave Britain decisive advantages over rivals, and how financial technology, rather than military superiority, built and sustained the British Empire until the costs of 2 world wars finally exceeded even Britain's extraordinary fiscal capacity. Before 1688, Britain was not a major power in European politics. France under Louis XIV dominated Europe with the largest army, the most sophisticated administration, and control over much of the continent, while the Dutch Republic held position as the wealthiest trading nation with the most advanced financial system and the largest merchant fleet. And Spain still controlled vast territories in the Americas and significant European possessions. Britain remained a secondary power, recovering from decades of civil war and political instability. 1642 to 1651 brought the English Civil War, which devastated the country, killed the king, established a brief republic under Oliver Cromwell, and then restored the monarchy in 1660 under Charles II. Political instability continued with constant conflicts between king and parliament over taxes, over religion, and the limits of royal power, while Charles II and his successor James II struggled perpetually to raise sufficient revenue for government operations and military expenses. British monarchs couldn't reliably borrow money because lenders didn't trust that loans would be repaid. Kings had a long history of defaulting on debts, seizing lenders' assets, or simply refusing to honor obligations when politically convenient. And interest rates on government borrowing climbed extremely high, often 10% or more, because lenders demanded compensation for the significant risk of default. This meant Britain couldn't sustain expensive wars against major rivals who had better access to credit. Tax collection proved inefficient and limited. Parliament controlled taxation and refused to grant the king permanent revenues large enough to fund an effective military or conduct sustained foreign policy. And the king's income came primarily from customs duties, crown lands, and various feudal privileges, none of which provided enough money for the kind of state building that France and other continental powers were pursuing. Britain lacked the fiscal capacity to be a great power. Naval power stood as Britain's only significant military advantage, developed during the Anglo-Dutch Wars of the mid-17th century. But even this was constrained by limited finances. Ships were expensive to build and maintain, sailors needed regular pay, and naval operations required sustained funding that the English government struggled to provide, which meant Britain could defend its coasts and conduct limited naval campaigns, but couldn't project power globally the way it would in later centuries. The Glorious Revolution of 1688 changed everything. Parliament invited William of Orange from the Dutch Republic to take the English throne, replacing James II in what amounted to a bloodless coup. And William brought Dutch financial expertise and a commitment to parliamentary government. More importantly, the political settlement that followed created the conditions for the financial revolution that would transform Britain from European backwater to global empire. If this deep dive into the British Empire's economic foundations is what you're here for, subscribe to The Economic History. We analyze how financial systems build and break empires. Next video, we're continuing with more civilization-scale economic analysis. 1694 brought the creation of the Bank of England. And this institutional innovation made the British Empire possible. William Paterson, a Scottish merchant and entrepreneur, proposed creating a bank that would lend money to the government in exchange for incorporation as a joint stock company with special privileges. Parliament approved, and the Bank of England launched with an initial loan of £1.2 million to the government at 8% interest. What made this different from previous government borrowing came down to credibility of repayment. Parliament guaranteed the loan and established permanent taxes specifically dedicated to paying the interest, which meant lenders knew they would be repaid because Parliament controlled taxation and Parliament had authorized the debt. This created a virtuous cycle where reliable repayment led to lower interest rates, which allowed more borrowing, which funded more military operations, which brought more revenue from trade and conquest, which allowed even more borrowing. National debt developed rapidly after 1694. Instead of borrowing small amounts at high interest for short periods, Britain could now borrow large sums at relatively low interest for extended periods. And by 1750, Britain's national debt had grown to about £78 million. Enormous in absolute terms, but manageable because interest payments consumed only a fraction of government revenue, and because lenders trusted they would be repaid. France, Britain's main rival, possessed a much larger population, a bigger economy, and greater total wealth. But France couldn't borrow as cheaply or as reliably as Britain. French kings still defaulted periodically on debts. French taxation remained inefficient and regressive, and French government finances were chronically disorganized, which meant when Britain could borrow at 3 to 5% and France paid 8 to 10% or higher, Britain could sustain wars that France couldn't afford despite France's greater resources. The fiscal military state emerged in Britain during this period. Government spending focused heavily on the military, particularly the Royal Navy, and on servicing the national debt, while tax revenue increased through more efficient collection and new taxes on consumption like excise duties on items including beer, spirits, salt, and candles. The bureaucracy expanded to administer the tax system and manage the debt, and Britain became extraordinarily good at extracting resources from its population and converting those resources into military power. Between 1688 and 1815, Britain fought a series of wars against France and other European powers. The 9 Years' War, War of Spanish Succession, War of Austrian Succession, 7 Years' War, American Revolutionary War, and the Napoleonic Wars. Britain won most of these conflicts, not through superior armies, but through superior finance, since Britain could afford to stay in wars longer, subsidize allies, and maintain naval superiority even when battles on land went poorly. Financial capacity became military capacity. The 7 Years' War from 1756 to 1763 demonstrated the power of the British fiscal military state. Britain fought France across multiple continents simultaneously in Europe, North America, the Caribbean, Africa, and India, and British national debt nearly doubled during the war, reaching about £133 million by 1763. But Britain won decisively. France lost Canada, most of its possessions in India, and its position as the dominant European power, while Britain emerged as the world's leading colonial and commercial power, all financed through debt. Converting debt into military power required a sophisticated system, and Britain's approach proved ruthlessly effective. Tax revenue flowed into the exchequer, where it was divided between current expenses and debt service. Interest on the national debt was paid first and reliably, which maintained confidence among lenders and kept borrowing costs low. And anything remaining went to government operations, primarily the military. The Royal Navy consumed the most money and represented the most important component of British military power. Ships of the line cost £50,000 to £70,000 each to build, required crews of 500 to 850 men, and needed constant maintenance and repair. While a fleet large enough to dominate European waters and protect global trade routes cost millions of pounds annually, yet only Britain's financial system could sustain this expense continuously across decades. Naval supremacy gave Britain control over global trade routes and the ability to project power anywhere accessible by sea. French and Spanish armies might be larger and more powerful on land, but Britain could blockade enemy ports, cut off overseas colonies from reinforcement, and land troops wherever naval power could support them. And the British Empire fundamentally operated as a maritime empire, since maritime empires require sustained financial investment in naval power. Subsidies to continental allies provided another way. Britain converted financial capacity into strategic advantage. During wars against France, Britain paid Austria, Prussia, and other European powers to field armies that tied down French forces on the continent, which meant Britain essentially bought military power by financing other countries' armies, cheaper than maintaining equivalent British forces and more effective strategically, because it kept France fighting on multiple fronts. By 1815, after the final defeat of Napoleon, Britain's national debt had reached about £1 billion, roughly 200% of GDP. This sounds catastrophic by modern standards, but the debt remained serviceable because Britain's tax system generated enough revenue to pay the interest. Lenders trusted they would be repaid, and borrowing costs stayed relatively low. And Britain never defaulted, never inflated away the debt, and maintained fiscal credibility throughout. The contrast with France turned stark. France emerged from the Napoleonic Wars defeated, occupied, and financially exhausted. French government finances had collapsed repeatedly during the Revolutionary and Napoleonic period, and France had tried everything from confiscating church property to issuing assignats backed by confiscated land to outright default, none of which worked sustainably. Britain's boring, reliable system of parliamentary taxation and credible debt repayment had defeated France's more dramatic and unstable approaches. Britain's victory over Napoleon in 1815 established British dominance that would last a century. No European power could challenge British naval supremacy or British control over global trade. And the Pax Britannica, the British peace lasting from 1815 to 1914, rested on financial foundations laid in 1694 and refined through 120 years of expensive wars. Britain had proved that superior access to capital could overcome disadvantages in population, territory, and resources. 1600 brought the founding of the East India Company as a joint stock trading company with a royal charter granting monopoly rights over English trade with Asia. For its first 150 years, The company operated primarily as a commercial operation, buying spices, textiles, and other goods in India and Southeast Asia for sale in England and Europe. And profits were substantial, but the company didn't control territory or govern populations. That changed in the mid-18th century. 1757 saw the Battle of Plassey, where a small East India Company force under Robert Clive defeated the Nawab of Bengal. And the victory gave the company control over Bengal, one of the wealthiest regions in India, which meant the company suddenly possessed not just trading rights, but political authority over millions of people and the ability to collect tax revenue. Corporate profit and imperial conquest merged. The East India Company became the vehicle for British conquest of India. Company armies composed primarily of Indian soldiers called sepoys, commanded by British officers, conquered territory after territory. The company collected land revenue, administered justice, negotiated treaties, and exercised all the functions of government while remaining nominally a private commercial corporation. And this represented empire building privatized and made profitable. Revenue from India proved enormous. Bengal alone generated millions of pounds annually in land taxes. And as the company expanded control across India, the revenue grew proportionally. While some of this money flowed back to Britain as dividends to shareholders, some financed further military expansion, and some lined the pockets of company officials who became extraordinarily wealthy through corruption and private trade. The nabobs, company officials who returned to Britain with fortunes made in India, became symbols of both imperial wealth and exploitation. Company rule often turned brutal and extractive. Famines in Bengal in 1770 and later years killed millions, partly due to company policies that prioritized revenue collection over food security, while traditional Indian industries like textile manufacturing were undermined as the company redirected Indian production toward raw materials for British factories. The economic relationship operated as colonial in the worst sense. India produced cheap raw materials and bought expensive British manufactured goods. By 1858, after the Indian Rebellion of 1857, the British government took direct control of India from the East India Company. The company dissolved as a governing entity, though it continued as a commercial operation until 1874. But the pattern stood established. India represented the jewel in the crown of the British Empire, providing revenue, raw materials, markets for British goods, and military manpower. Without India, the British Empire would have been dramatically smaller and less wealthy. The East India Company model demonstrated that empire could be profitable in direct financial terms, not just through abstract benefits like prestige or strategic position. India paid for its own conquest and administration, generated surplus revenue that helped finance British operations elsewhere, and created opportunities for private enrichment that made imperial careers attractive to ambitious Britons. Corporate colonialism worked, at least from the perspective of the colonizers. 1821 brought Britain's formal adoption of the gold standard, establishing that Bank of England notes were convertible to gold at a fixed rate. This meant the pound sterling rested on gold reserves and maintained a stable value that made it trusted internationally. And other major economies followed Britain onto the gold standard over the following decades. While by 1870, an international gold standard system linked the world's major currencies. Sterling became the global reserve currency between 1815 and 1914. International trade was conducted in pounds. Foreign governments held reserves in sterling, and the Bank of England acted as the central bank for much of the world economy, which gave Britain enormous advantages, including the ability to run persistent trade deficits because other countries needed sterling for international transactions, lower transaction costs for British merchants and investors, and significant influence over global financial conditions. The City of London developed into the world's financial center. banks, insurance companies, commodity markets, and stock exchanges concentrated in London because that's where international capital flowed. And British investors financed railways in Argentina, mines in South Africa, infrastructure in India, and government bonds from countries across the world. By 1914, Britain held about 40% of global foreign investment, and the returns on those investments provided a substantial portion of British national income. In a free trade ideology dominated British economic policy during the Victorian era. The Corn Laws, which had imposed tariffs on imported grain to protect British agriculture, were repealed in 1846, and Britain embraced free trade because British manufacturers could outcompete most foreign rivals. British merchants benefited from unrestricted global commerce, and British financial institutions profited from financing international trade. Free trade worked for Britain because Britain's head start in industrialization gave it comparative advantages. The empire provided captive markets for British manufactured goods and reliable sources of raw materials. India bought British textiles, Australian wool fed British factories, Canadian wheat fed British workers, and African and Asian colonies provided rubber, metals, and other resources that British industry needed. While imperial preference systems gave British goods favorable treatment in colonial markets, and colonial goods favorable treatment in Britain. Economic integration of empire generated profits for British businesses even as it distorted colonial economies. By 1914, Britain's GDP stood at about 7 times larger than in 1830. Population had more than doubled, and London reigned as the unquestioned financial capital of the world. Sterling circulated globally. The Royal Navy protected sea lanes everywhere, and British investment reached every inhabited continent. While the empire at its peak encompassed roughly 25% of global trade and 25% of the world's population. This represented the Pax Britannica fully realized, an empire built on financial technology and sustained by continuous capital accumulation. But the system contained the seeds of its own decline. Maintaining the empire proved expensive. Rivals like Germany and the United States were industrializing rapidly and would soon match or exceed British economic output. And the costs of the coming world wars would prove beyond even Britain's extraordinary fiscal capacity. The golden age of British financial dominance was approaching its end. Though few recognized it in the confident years before 1914, the First World War destroyed the foundations of British financial supremacy. Between 1914 and 1918, Britain spent about £9.5 billion on the war effort, more than the entire national debt that had accumulated over the previous 2 centuries. And Britain borrowed heavily from the United States, sold overseas investments to pay for weapons and supplies, and by 1918 had transitioned from the world's largest creditor nation to a major debtor. War cost Britain its financial dominance. Sterling never fully recovered its pre-war role as global reserve currency. The United States emerged from World War I as the world's largest creditor. New York challenged London as a financial center, and the dollar began displacing the pound in international transactions, while Britain attempted to return to the gold standard at pre-war parity in 1925. But this overvalued sterling, made British exports expensive, and contributed to economic stagnation through the 1920s. The policy was abandoned in 1931 during the Great Depression. The Second World War completed the process. Britain again borrowed massively, primarily from the United States through Lend-Lease, and emerged from the war victorious but financially exhausted. And the empire became economically unsustainable when Britain could no longer afford to maintain military forces across the globe, and when nationalist movements in colonies demanded independence. Decolonization between 1947 and the 1960s dismantled most of the empire, with India's independence in 1947 being the most significant loss. The Bretton Woods system, established in 1944, formalized the dollar's displacement of sterling as the primary global reserve currency. Thus, the United States now possessed the financial advantages that Britain had enjoyed from 1815 to 1914. Ability to run deficits funded by foreign holders of dollars, seigniorage profits from issuing the global currency, and influence over international financial conditions, and British decline and American ascent were two sides of the same transformation in global financial power. The lesson from the British Empire's rise and fall is that financial technology and fiscal capacity are fundamental to imperial power. Britain's advantage from 1694 to 1914 wasn't superior culture, better governance, racial superiority, or divine favor, but the ability to borrow cheaply, tax effectively, and convert debt into military power more efficiently than rivals. And when that advantage disappeared after 2 world wars, the empire became unsustainable and collapsed. Modern parallels are obvious. The United States today occupies the position Britain held in the 19th century, issuing the global reserve currency, maintaining the world's most powerful military, and running persistent deficits financed by foreign holders of dollar assets, while China is industrializing and accumulating capital the way Germany and the United States did in the late 19th century. Financial foundations of American power aren't permanent any more than Britain's were. And future historians may look back on American dominance the way we now look back on the Pax Britannica. Empires rise through superior finance, project power through sustained debt, and fall when the costs exceed even their extraordinary fiscal capacity. The British Empire demonstrated this pattern across 2.5 centuries, and financial technology built the largest empire in history. While when the financial advantages disappeared, the empire disappeared too. Subscribe to the Economic History for Civilization-Scale Economic Analysis, examining how financial systems shape the rise and fall of empires, nations, and economic orders.